Equities, also known as stocks, represent ownership in a company. Investing in equities provides the potential for capital appreciation and dividend income, making them an attractive investment option. Equities are traded on stock exchanges such as the New York Stock Exchange, NYSE, and NASDAQ. Common stock is the basic form of equity ownership in a company. Common shareholders have voting rights, are entitled to dividends, and have a residual claim on the company's assets after debts and preferred stock are paid. While common stock offers higher potential returns, it also comes with higher risk compared to preferred stock and bonds. Preferred stock is a type of equity that provides fixed dividend payments and has priority over common stock in the event of asset liquidation. Preferred shareholders typically do not have voting rights, but they receive dividends before common shareholders and have a higher claim on assets. Preferred stock carries lower risk than common stock, but it also offers lower potential for capital appreciation. The main differences between common and preferred stock include voting rights, dividends, and risk-return profiles. Common stockholders have voting rights, while preferred stockholders generally do not. Common stock dividends vary and are not guaranteed, whereas preferred stock dividends are fixed and paid before common stock dividends. Common stock carries higher risk and potential returns, while preferred stock offers lower risk with fixed returns. In addition to common and preferred stock, other types of equity securities include convertible preferred stock, warrants, and rights. Convertible preferred stock can be converted into a specified number of common shares. Warrants are long-term options to buy a certain number of common shares at a specified price. Rights are short-term options that allow existing shareholders to buy additional shares at a discounted price, often issued to raise new capital. Equity investment strategies vary depending on the investor's goals and risk tolerance. Growth investing focuses on companies with high potential for earnings growth, often reinvesting profits to fuel expansion. Value investing seeks undervalued stocks with strong fundamentals, aiming to buy low and sell high. Dividend investing targets stocks that provide regular dividend income, appealing to investors seeking steady cash flow. Let's compare an investment of $10,000 in common stock versus preferred stock. Common stock offers a potential annual return of 8%, but comes with high volatility, resulting in a potential return of $800. Preferred stock provides a fixed annual dividend yield of 5% with low volatility, resulting in a dividend income of $500. This example highlights the trade-off between potential return and risk in different types of equity securities. Using Python and libraries like NumPy and Matplotlib, we can calculate and compare the returns of common and preferred stocks. By defining functions to compute the returns, we can visualize the growth of an initial investment over time. This example demonstrates how common stock can potentially offer higher returns, but with greater volatility, while preferred stock provides steady, lower risk returns. Equity securities include common stock, preferred stock, convertible preferred stock, warrants, and rights, each with unique characteristics and benefits. Investment strategies like growth investing, value investing, and dividend investing cater to different investor goals. Integrating Python for calculating and visualizing returns enhances understanding and supports informed investment decision-making.